In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
$1.75%, but yeah, they're down on the day.
So it's kind of led us into this discussion here for our topic. But before we do it, I wanted to show you right outside these windows. I wanted to do it outside, by the way, Stu, on the balcony out there. We got a cabana that's blaring music. It's also very washed out. The lighting's not real good. But just outside of those there's the view. And there's the ocean out there and the little marina hotel right on an island. It's absolutely spectacular, but it is cold. I think it was 42 here, like Philly weather.
See that boat right in the middle of the water? I want to retire on that boat. That's where I want to spend the rest of my days. That's exactly correct. Yes.
Would not be a bad spot. So anyway, a little different setup for me here, and I apologize for that. It's going to be a little awkward for me to try to maneuver things. But we have another really good Coach's Corner for you here. And as always, we're going to start off with Chalk Talk. So for those of you who are new, it's a little bit of I don't know if I want to call it a trivia question, but more of a challenge question that we'll answer for you at the end of the presentation. Now, sometimes these questions follow along with the presentation, and sometimes they're something completely different. But here's our question for today, Stu. You bought 100 shares of a stock for $100 per share. You've written calls against, you've been doing this covered call strategy, and let's say you've written it down to a cost basis of 80. So over time, you've collected $20 in premium. Now, maybe sometimes you took losses, sometimes you've gotten gains, but overall, you've got a net 20. So most traders would say I've got a cost basis of 80. And the question is, how much do you have at risk for the next call that you write?
I feel like this is another one of these trick questions.
It's not for you, it's not. But it's definitely going to challenge some of our viewers out there, some of the newer people, which is fine. That's what we want to do. But I want you to think about it. I want you to write down the answer. What's your risk? How much do you have at risk? And we're going to come back and revisit this at the end. But today, Stu, I've got another topic for us. I just thought because of the recent downturns, I know you've heard about this. I hear it all the time. We've both heard it in Q&A, but it is the stock repair strategy. Now, without even going into the presentation yet, I have a feeling, at least I'm hoping you and I are on the same page about this. How do you feel about, before we've even explained it, how do you feel about this strategy?
I have a huge problem with this strategy. It's not even a strategy. I just have a whole major malfunction with this word repair. In my world, it just doesn't exist. To me, it's more of a marketing term. It's just a term to try and describe another strategy. But as far as fixing the $20,000 I just blew on the short puts that I sold, no, not a buyer of this whole idea of repairing the strategy.
Right. I agree. It's like all strategies, it's a tool. There's a time and a place where it can be the perfect solution. The problem that I have with it, as you mentioned, is the word repair. And what happens to new traders, they'll say, oh, there's this magic strategy out there where you can just hit the repair button. So you don't really even have to worry about the stocks that you buy because you can just repair them. Well, of course you can repair them, right? You could, I mean, if your radiator blows, you can get that repaired too, but there's a cost. You can always repair the stock, but there's a cost. And that's really what we have to weigh as traders. So let's dive deeper into the stock repair strategy, find out what it is and why. Now, I kind of had a feeling you were going to take that viewpoint, why both of us are at least a little wary of the title and the terminology.
Yeah.
So
there's no fixing something. There's
right.
things you can do using
a new
that.
trade.
A new trade. It's just a new trade.
It's a new trade.
If you want to play accountant and kind of book the two together at the end of the day, be my guest. But they really are nothing to do with each other. It's just an idea that you created from the idea of, oh my God, I just dropped 10 grand. What am I gonna do now?
To get it back. So here's our setup. You own some shares that have fallen sharply. Of course, I know that's a relative term, but let's say that it's maybe roughly 20% or so. So, I mean, if you have a stock that is 400 that's down to 5, this strategy isn't going to work for you. We're talking about, we're trying to just see that it's taken a little bit of a hit, not a massive hit, but 20, 25% or so. And so that's the situation. And you're really trying to get your money back sooner. Now, this bullet.
Sooner is a key word here. Sooner.
Right.
And money back is, I agree. Go. I agree. I agree. This whole thing just irks me, but go ahead.
And we're going to find out why. But for most traders, this is the way that they see the strategy. Maybe I'm willing to hold it. I think it is going to come back from 80 to 100, but it's going to be super slow. And I'd really just like to get my money back. Say, I wish I'd never entered this trade. And I just want to get my money back sooner. So that's really the setup. But we have to be willing to give up the unlimited upside in the stock. That is the cost. Now, as we're going to find out, there's not a real out of pocket cost to us with this. And that's one of the things that makes it kind of creative and neat and interesting. It does not cost
this is kind of opportunity. We're talking about possible opportunity to the upside.
Right. That is really where the cost is. And this is where, once you understand the strategy, you'll see that this is where the decision is going to rest. So here's the stock repair strategy. What you're going to do is use a strategy called a ratio spread. Now, we've talked about vertical spreads where you're going to buy an option, sell an option in equal proportion. So buy 1, sell 1, buy 5, sell 5. Ratio spread, you're going to do the opposite. You might buy 1 and sell 2, or buy 2 and sell 7. They're not in equal proportions. So it's a ratio spread. You're going to buy the call, but you're going to sell more calls at a higher strike. That's just a basic definition of a ratio. Now, for the stock repair, you are going to use what's called a 1/2 ratio spread. Some traders will call it, or for clarity, we'll call it a 1/-2. What that means is you're going to be long 1. That's the first number here. -2 means that you are short 2. Now, some traders, like Stu down on the floor, it's kind of implied that if you say it's a ratio that we know the second number is negative, so they might just call it a 1/2.
1/2, or otherwise known in floor lingo as a front spread. This would be a front spread. Buying spread. 1, selling 2, a little ways down the road in front of you. The other way, you could actually do it the other way, which you would be selling 1, buying 2, and that would be the back spread. Same idea. It's just the other way. This is 1/2, buying 1, selling 2, front spread, ratio spread. But, and look, some people are going to say, hey, can I do 1/3, 1/4? You can, but it's a different dynamic and it's a different set of, risk parameters. But let's go with this 1/2 front spread. Go ahead.
Now we're going to find out the reason that we do the 1/2 here is, again, trying to get a net 0. And so that'll make more sense in a moment. So let's say that you buy one call and you're going to sell 2 calls at a higher strike. And
remember that we had 100 shares of stock, right? Is that what we were starting with? 100 shares?
We're starting with 100 shares of stock.
100 shares. So we're going to buy one call and we're going to sell 2 calls. Okay.
Right. And the whole key is that we're trying to get this to a net zero. And what that means is that the options that you're selling are going to be roughly half the price of the one that you're buying. So if you're buying one for $5 and selling 2 for $2.50, you're spending $5 and collecting $5. That would be a net zero. Now, in the real world,
it's also a net zero in terms of deltas down the road, possibly. Could turn into selling 2 is 200, buying 1 call is 100, and the 100 that you already own is 100, net zero. But what Bill's referring to here is the capital required to put this on, which is net zero, 1 by 2. Go ahead, Bill.
Right. Not going to be any money out of pocket. And again, that's what makes people think, oh, what a cool solution. I don't have to spend any money for it. Now, again, in the real world, it might be a slight credit of 10 cents, might be a slight debit. But the basic idea is that you're not having to put out a lot of money to put on this ratio spread. Well, now the question is, what does the ratio spread do for us? We've got 100 shares of stock. It's gone against us maybe 20, 25%. And now we're looking at putting on this ratio spread. What's that going to do for us? Well, we're going to find out. And before we do, as always, if you like this kind of education here, more than just the typical, here's the definitions, here's your break evens that you can find anywhere, please visit marketrebellion.com/get started. Lots of free stuff that will help you to really become better with options and make better decisions. So here are the conditions. If we're going to put on this ratio spread as part of a repair strategy, you must be at least mildly bullish. This is critically important. You don't want to say, oh my God, the stock has come unraveled. I want to repair it. Why? Because I think it's going further south. No, this is not the strategy for you. You have to at least say, I think we've bottomed out. It's going to climb. It's just said it's going to be a really slow climb, and it's going to be a long time before I get my money back. All right, so don't lose sight of that. You've got to be at least mildly bullish. And what you're trying to do is to reach the break-even point sooner. If I had to wait for the stock to go from 80 to 100, that might take X amount of time. But if I only need it to go to 90, that's going to be a lot sooner, assuming the stock does in fact go up. That's really the idea behind the stock repair. However, we have to give up the unlimited potential gains in the stock. So remember, there's always a cost. Might not be out of pocket, but there's always a cost. So Stu, let's overlay these. Now here in black is our stock position purchased for 100. And let's say maybe the stock is down here at 85 or 87 somewhere, and we buy the 90, and sell 2 of the 95s. Now by itself, the ratio spread's got a lot of risk. We got unlimited risk up here to the upside. The stock position in black, we've got unlimited downside. So now it looks like we've got a whole bunch of risk. But when we put these in together in our account, what happens? We go to this. We actually flatten out here. What's going on here? We have 200 deltas over here, and we've got 0 over here. So Stu, why don't you explain, how do we end up with 200 deltas over here between our 90 and 95 strikes?
You got to break it. You got to not get lost in the noise, and you got to break down what you have. Just take a minute and just kind of take a deep breath and look and see what you have. What you have is 100 shares of stock. That's 100 deltas. We don't talk about deltas when we talk about stock, pretty much because there's no curvature to it, and it's always 100 deltas is always going to be 100 deltas, right? But options do have a curvature. So when we talk about exposure in terms of movement, we talk about deltas. So the 100 shares is 100 deltas. And the one call that you buy can be 100 deltas. You got to think about what is the deliverable. The deliverable, what it can give you at some point, it won't act like it now, but at some point it could give you, if you choose to let it give it to you, is 100 shares. So 100 shares that you have, 100 shares of deliverable, that's 200 deltas. That's where you get the 200 deltas. when you're thinking about the 1x2, again, keep it easy, keep it simple. Just say to yourself, what do I have? And what you have is one vertical spread. It's 1x2. So one long, one short, that's a vertical spread. And then you have this other short, which is the other part of 2, 1 and 2, and then you have one left over. You pair that against the stock that you own, and now you have a covered call or a buy rate. You have a buy rate and a covered call. So you really have kind of like two little things working here. You got the covered call, long stock, short call, and you have one vertical spread. You know that the one vertical spread will cap out at a maximum value of the difference between the strikes.
Right.
And you know that the covered call will cap out when the call gets to be 100 delta and you're just being a participant at that time as the stock continues to go up, which is why it flattens out. Nothing really happened to the curvature of the downside because there is no curvature to the downside. All you did was create some possible exposure to making some money on the upside while your downside, you didn't take any money in. Remember, you did a 1x2 for even, and on the downside, you still have your 100 shares of stock, which is not protected at all. So
this is why you have to have at least be mildly bullish. You don't do the stock repair because you say, oh my God, I'm deathly afraid of the stock. I think it's going to fall further. Let me repair it. You can see that is not going to cut it. You still carry all of the downside risk. The benefits are above the long strike. So as Stu just explained, yes, see what's happening, the benefit of the strategy is I don't want to say we didn't pay for it. We didn't spend any money out of pocket. And you can see if we stayed.
Check this out. Check this out. If you tweak this a little bit, this is just a little one-off. You can tweak this a little bit and you can shorten the distance on the vertical 1x2 on the vertical spread. And you might have a net credit at that point.
Sure.
And if you have a little bit of a net credit, you could actually turn around and buy an out of the money put, and you can help you can help create some tailside curvature to the downside. It's just a little tweak in there.
Absolutely. Yep. That's a very cool addition to it. But the thing that the basic stock repair strategy is that you're trying to lever this, you're trying to ramp this up here in blue. If you stayed on the black line, it would take you all the way up here to 100 to break even. But you can see now we're breaking even more at about 95. And we're just trying to get our money back, which is why we flatten. Now, I know what Stu talked about might be a little confusing. So here's the breakdown of it. Kind of hard to visualize, but here is our 1/-2. And here's the long stock position. Okay, so remember we started with the stock. We put on this 1/-2 for 0. Well, instead of looking at selling 2, let's split this up.
$0. Right, Bill? Is that what you're saying? $0. Yeah.
$0. So we're going to split this one up. And we're going to look at it as though buying 1, selling 1, and then selling the 95 against the stock.
Yes,
so this first one up here,
Yeah.
buying 1, selling 1, is the 90-95 vertical, which, as Stu said, flattens out at the top. And down here is a covered call, stock plus a short call, which also flattens out right there. That's why we have 0 deltas on the top.
This is so funny. And I didn't see these slides before we did this, everybody. It's like, this is what it is. This is how simple it really can be. You just have to break it down and not get lost in the noise and see what do you have and how do you win and how do you lose, and what being able to kind of look into the future and just say, this is what this comes back to knowing your strategies. Just knowing your strategies and trying to take a strategy and apply it to a situation that you have and saying, how can this help me? And how can it hurt me? And the thing about the cost is, most people think about cost as, well, it's going to cost. Is it going to cost me any money? I got to take money out of my pocket here. Here's money. It's going to cost me money. Well, that's not always the cost. The cost, as Bill referred to, can be opportunity cost.
You're selling
and that's
off
really what you're giving up here. You're selling off what's called the tail. That's an opportunity cost. It may or it may not come to fruition. It's something that we don't know.
It might be a big one.
It might, right? It might. If this thing rallies to 120, it's an opportunity cost for sure. Yep,
absolutely.
For sure.
So this is a nice way to break it down. And for those of you who have some of the more advanced platforms, things like Thinkorswim will allow you to combine these, and it will show you the spread that we saw on the previous. It'll actually show you this in blue. even though you
You
entered
can
in
put
these.
both of those.
You could put both of those in, it'll break it down for you. So even
Yeah,
if you
cool
don't,
little trick on Thinkorswim. Yep, absolutely.
so even if you don't understand this in your head, be able to break it down, and you'll eventually get there the longer you work with it, but at least understand how to put it into a platform. And that will help you to realize that it's just a vertical spread and a covered call, both of which have zero deltas on top. And that is why you do not participate in any future gains. It is strictly about trying to double up on those deltas to get your money back sooner. So why do we have the problem with the word repair? Well, the reason is there is no repair. Every trade stands on its own. A stock repair is a new trade designed to reach, it's a new trade, period. It's a new set of risks, a new set of rewards, and it's designed to reach a break-even point earlier. Now, again, one of the things that's kind of cool about it is that, yeah, it's not any out of money expense, but it is still a new trade. And you are still accepting the downside risk.
Right. Remember, you still have that 100 shares of stock and you didn't take in any money. It wasn't like you sold premium to help your downside if it goes the wrong way. You didn't take in any money. And you still have 100% of that downside risk by owning the stock. Yet another reason to own a stock replacement call, but we'll save that for another topic, huh, Bill?
Absolutely. But this is also why you could say, all right, I had the stock at 100, it's trading for 80. I could choose to sell it and just take my lumps. But you're saying, no, I want to repair it. And so that's why we're a little funny about this word repair, is you're choosing to continue holding the thing that hurt you in the first place in exchange for getting to a break-even point sooner. So this goes back to why you have to be at least mildly bullish.
You have to keep your discipline in check here. You can't let your ego get in the way. You have to be able to say, I want to do this because I like the trade. I like the stock at this new level. If you don't like the stock at this new level, beat it, get out. You're done.
Yep.
If you like the stock at the new level, maybe it's sitting on a support line. Maybe it's made the V. Maybe it's made the turn. Maybe you have 2 or 3 candles with a bullish harami, whatever. If you like the stock at this new level, this is a way to create some additional opportunity in the nearer kind of move to the upside while giving up something on the back end. And it could very well work.
Yep. But as we've always talked about, I think what you and I mostly agree with whenever we hear the terms repair or trying to get my money back, is this any different from selling the stock and moving the money to another position? I mean, why, if you really thought that if we're an ABC stock and we really thought XYZ was going to go to the moon, why stick around in ABC and do the repair strategy? Just take the loss and move it to XYZ and you'll make it up faster. See, the repair strategy. Yeah.
Okay. I have a question for you. So if my kid goes to the casino and he drops $500 playing blackjack on Wednesday night, and then he goes out over the weekend and he mows some lawns. He does a flea market. He works some flea market and he makes himself $500. Did he repair his Wednesday night debacle?
That's
I don't know.
Right. And that's exactly it. You have to remember, money is money. It all comes from the same account. These fall into what are called mental accounting errors from the field of behavioral finance, that you're really saying, well, because I got it from the same stock, that somehow I've repaired it. But all you're really doing is putting new money in the face of risk, trying to make up for a loss. And as Stu said, it's no different. You want to know how you can also make it up? Go work a part-time job until you make the money. Did that repair the position?
I'm trying to retire. I'm not trying to get more work.
According to the definition, it did. Because you're just trying to get that money back. See, the illusion is that it came from the same stock and that it didn't cost you anything.
Yeah,
and that's
it really is just an illusion.
It is just an illusion. But the thing that I do think on the positive side that is cool about it is that if the stock takes that 20 to 25% hit, it's very easy. Try it for yourselves. Go look at a broker's platform and you'll see that you can buy 1, sell 2 for just about 0. And so that's what makes an interesting thing that you might not have thought about. But the thing that we want to caution people against is don't say, don't worry about what stocks you buy, because you can always push the magic repair button. And that doesn't exist. Actually, it does, Stu. In Thinkorswim's paper money, you can click reset. And that
Reset,
will,
yeah.
and that is that's a true repair strategy. But as you know, in the real account, they seem to have left that button off of there. This is just a different trade.
I'm looking at Starbucks here. Just kind of pulled something off the top of my head here. Starbucks going out 6 weeks, 31 March, 105,
Okay.
110, 105. No, I'm sorry, 110, 115. A little bit out of the money. Stocks 107. These are the 110, 115s. The 110s are trading for 2.5. The 115s are trading for about 1. So 1 and 1 is 2, and you got about 50 cents into it. You can tweak it. You can go down to maybe 114, sell them for 1 1/4. 1 1/4, 1 1/4 is 2.5. You do the 110, 114 for even, right? That's your front spread.
There's your
It's a
front
little
one.
bit out of the money. You're mildly bullish. You make money on the buy right going up. You make money on the 1-by-1 vertical spread going up, and you're tapped out after 110, and it's or after 114, and that's the game. That's what you can do, and you don't get annoyed because it went to 120. Because you wanted what you wanted, you knew what you were up for, and that's it. You move forward. You always have to move forward. You move forward. You move forward. You move forward.
Yep. And so that's another good point too. When you look down your broker's platform, you say, "Oh, here's the strikes that give me a net zero." Well, there's nothing that says you have to use that one. What if that doesn't really get you? You don't really think the stock has that potential. Well, maybe it would be in your best interest to pay a 50-cent debit to get to your break-even point sooner, even though it wasn't a net zero. So you do have to use some common sense, but they still fall into this category of stock repair strategy. So I just thought that would be a fun one to talk about, Stu, because especially with the recent downturns in markets, we've heard a lot of people saying, "Can you review the stock repair?" There's a lot of people out there selling it as pay for our secret webinar, and we'll show you how to repair these stocks. It's just another repair. It's just another trade.
Just another trade, just another strategy. One final comment on this. If you take a look at the 110 and that same Starbucks example, just to kind of bring all the viewers into a practical example, if you flip this into a 110, 113 instead of a 110, 114, you actually wind up, because the 113s are 1.5. So 1.5 and 1.5 is 3. You're paying 2.5 for the 110s. You actually wind up with a slight credit, 50 cents. Move yourself into the 95 put, same expiration at 50 cents. Now you made a straight line on the left side of that graph, and you stopped out you bought the right to sell it at 95, which means you stopped out your losses at 95. You actually bought the right to walk away. You bought the right to sell it, puts or calls or puts, sell the cash at 95. And that's it. So, that's just a new trade moving in. You don't get to use the 50 cents in your accounting. Well, I did it for a credit. You get to say, I'm going to purchase the downside to protect my downside. Yep. Mm-hmm.
So the main thing is to remember that whenever you hear stuff like this about a repair, any strategy could be a repair. Bought the stock at 100, is trading for 80. Hey, Stu, why don't we go buy the Microsoft vertical spread? I make money on the vertical, and I say it offset my losses there. Did it really repair that? People would say no in that case because it's a different ticker. But because we stayed with the same ticker and because we paid nothing for it, they suddenly say, it's the secret strategy that repairs it. And I think it's a cool strategy if you understand what the trade-offs are, but you must understand it is a new strategy with a new set of risks and rewards designed to get you to your break-even point sooner if you're willing to give up the upside. That's really what it is.
That's really key. You got to be willing to give something up in order to get that sooner thing working, right? You're giving up that upside down.
All part of the perspective that we talk about. So here's a good little example. This is Tesla. So take a look down here. What if we had been riding this in the stock, which a lot of traders did, and we hit down here and we go, I got to do the repair strategy. So we buy and sell the verticals in this range, or the stock repair, and then it
Yeah.
basically doubles.
Yeah, you're kicking yourself in the ass.
Now,
when you do
now
that.
you're saying, now you're going to say, oh, that wasn't much of a repair strategy. Well, yes, it is. It got you to break even sooner.
Absolutely. And
you have to
you're
remember.
annoyed because you gave up that tail. But
You
hey,
gave up the
that's
tail.
what you signed up. That's what you signed up for. So here's a
That's it.
twist on buying the downside. If you really don't care about the downside after the stock got cut in half and you love Tesla and you're mildly bullish, how about doing the tighter spread to create the small credit, then turn around and buy the out of the money call to get a tail?
To get the tail.
Right. There's a million choices. And that's what Bill and I try and do here, folks. We just try and get you to take a deep breath and to look at the bigger picture and just to realize that you're not stuck in a corner, that there are choices out there in the options world that the stock market world does not provide for you.
Right. And some of those choices, in fact, that's what makes it so difficult. And why sometimes people put these fancy sounding things like a stock repair strategy into a box. It's just one of 1,000 different things you could do. But it's easier to digest to say, just do the 1 by -2. But when you really understand options, you might say, well, maybe I don't want to give up the tail. There's so many different choices. And that's where it becomes fun and rewarding when you see all of them instead of just the secret strategy that so many people try to sell. So as always, if you like stuff like this, if you really want to take your trading to the next level, please check out marketroom.com/get started. Lots of free courses and videos there to help you understand what options are all about and how to make better decisions. So now, Stu, I hope that helped everybody because we know it's a good topic, but this is related. So let's go back and visit here. You bought 100 shares for $100 per share. You've written calls down to a cost basis of 80. The question is, for our viewers out there, how much do you have at risk for the next call that you write? Now, I'm going to answer for most people since we can't hear them out there, but I know what most people think. I have $80 of risk because that's what my cost basis is. Or I've heard people say, maybe I did it when the stock was at 30 and I now have a negative cost basis. I bought stock for 30. I've written $35 worth of calls. I have a -5. I own the shares for a cost better than free. Well, on one hand, that's true, but it doesn't mean you're without risk. So, Stu, what would you say is your cost here? Or would you even know based on the information that's showing?
I know you wanted me to say 80, so I'm glad you said it and I didn't. But the real answer is I have no idea because I have to know how much the stock is right now.
Ooh, very good.
Moving forward is my risk, Bill.
Yes, absolutely.
It's
not what you had into it.
There is so many people out there, hundreds, thousands of people that I've spoken to over the years that I've taught, that I've coached. I've been doing this a long time, where they own Apple at $40, $10.
And they say that's my
Amazon, and hey, it's okay. It's $100. It's okay if it goes to 50 because I own it at 10. Well, no, it's not okay. It's not okay to drop that $50. It's just not. Your portfolio, your value of your dollars has now dropped. And is that really okay? Because you did some booking accounting entry somewhere along the line that said, hey, I own it at 10. Come on. Right. It's just not the way to go.
Yeah.
It's just an accounting thing.
Yeah. I had give you one last example. When I worked on an active trader team, we had a guy whose grandfather was the founder of a big, I won't say the name, but a big publicly traded stock drug company. And he deposited 156,000 shares of this company worth about $60 million. And
it's a nice chunk of change. Yeah.
The cost basis was something like 10 cents. So now think about that. You just dropped this into your account. You got 60 mil sitting there. Would you say, I've got no risk because it can go all the way down to 10 cents and I'll still walk away with my original principal back? I doubt it.
Yeah.
I doubt it. I think you would feel a lot of pain if it went from 60 to 50. And so when you put on that trade, you have to remember your risk is the current market price. And if you remember that, it's going to keep you from having to fall back and say, do you know of any strategy where I can repair it? So, Stu, any closing thoughts?
Yeah, go back and read the articles. There is plethora of them out there. Go back and read the articles about Mark Cuban's collar. And put
Yep.
yourself in Mark Cuban. Put yourself in Mark Cuban's spot back in the late 90s when he sold broadcast.com, which was way ahead of its time. However, that's not the point. The point is that he was delivered shares of Yahoo stock in exchange for his company. And if you said to him back then, what's my risk? Is he going to start going through his books and say, well, it costs me $20 a share to build this company. So my risk is, Yahoo is 90. So my risk is 70 because it cost me 20. I mean, is he really going to say that?
No.
You're talking about billions of dollars. His risk was $90. That's what Yahoo was trading at the time. And that's exactly where he made his collar. He put his downside protection at 85. Go read about it. Cuban collar, Mark Cuban's Cuban collar goes down in one of the annals of one of the best trades in history. Right next to Peter Kellogg's First Options of Chicago trade. But it's a great learning lesson about this exact topic. What is your risk? Your risk is you're moving forward from today.
What's the value of the position now?
Today. There's so many different ways to spin that. Warren Buffett, he has resources to go out and value XYZ company. It's out there. It's a private company. It's a public company. It doesn't really matter. He's got the resources to value a company. He doesn't care where the stock price is trading. He doesn't care.
Doesn't know what you paid for it.
He just doesn't care. He knows he has confidence in his team to value a company. So if he values the company at 50 and it's trading at 70, well, he's not a buyer. But if it's for some reason trading at 40 and he values it at 50, then he's a buyer, right? And that's his risk is going to be based on where he values it. His real dollars of risk, if he pays 50, would be 50, but he's not buying it because it's overvalued. Right? There's a lot of lessons here about follow the money, follow the trade, follow the money. What can it do for you? How can it make money for you? How can it lose money for you? What's the extent of the cost or opportunity? And what's the extent of the downside if it turns around and goes the other way? Always questions that everybody has to ask yourself on each and every trade. And that's my closing statement of the day.
Yep. Know your risk. We've heard that before.
Know your risk. There it is. Know your risk. AKA Steve Levitt. Know your risk.
Just another version of it. So I hope that helps everyone. Just for those of you who are probably most people holding shares of stock that have gotten beaten down, and you might have stumbled across this stock repair strategy. It's not a bad strategy. It's just not the magic bullet strategy that everybody makes it out to be. A bigger issue is don't allow yourself to get into this position in the first place.
Yeah, that's exactly right. Have your parameters. Don't be doing something that you're going to regret because now it's too much money. Oh my God, what am I going to do? Yeah. That's the answer. The answer is don't let yourself get there. Live to trade another day.
And so those are some of the things we're going. Yep, absolutely. Live to trade another day. So those are the things we're going to be showing you here on Future Coaches Corner. I appreciate everyone joining us here today, especially since it's in a little makeshift room for me here in Coronado. But I know it's going to be a fabulous time, and I'll get some good pictures and share with everybody on Q&A and for cocktail hour. And with that, thanks for making it here, and we will see you next Thursday for our next topic. Don't know what that is yet, Stu, but we'll see you next Thursday, 4 p.m. Eastern Time for Coach's Corner.
All right. Take care. See you. Have a great time out there.